The stock market just threw a party for a 2-week ceasefire, then woke up with a hangover the very next morning. One headline: stocks explode. The Dow surges 1,300 points. Oil crashes 15%. Traders cheer like the war is over. 24 hours later, much of those gains evaporate. Futures turn red. The rally stalls. This wasn't peace breaking out. This was the financial system revealing exactly how it really works. Let's rewind just 6 weeks. February 28th, USS and Israeli strikes hit Iran. The Strait of Hormuz, the narrow lane that moves 20% of the world's oil, effectively becomes a war zone. Tankers reroute. Insurance rates skyrocket. Oil prices spike hard. Inflation fears come roaring back. Investors start hedging for the worst: higher rates, slower growth, another energy shock. Hedge funds pile into shorts. Algorithms load up on protective trades. The market price is in chaos. Then, late Tuesday night, President Trump announces the deal, a 2-week ceasefire, brokered fast by Pakistan. Iran agrees to safe passage through the strait. The choke point that had been strangling global supply is, in theory, reopening. Markets don't wait for details. They move at light speed. Oil futures plunge. Energy stocks get crushed. Everything else, tech, industrial, small caps, rockets higher. Why? Because the immediate risk premium that had been baked into every stock price suddenly gets yanked out. The math is brutal and simple. Lower oil equals lower inflation expectations, equals better odds the Fed won't have to hike again. Traders who had been short or hedged heavy suddenly scramble to cover. It's not a belief in lasting peace. It's a stampede to unwind crowded positions before they get squeezed even harder. But here's the part the headlines missed. By Wednesday afternoon, cracks appear. Iran's state media hints the strait is still contested. Questions swirl about whether Lebanon was even part of the deal. Reports of violations start leaking. The truce is temporary by design. 2 weeks, conditional, fragile. Diplomats are still talking. Nothing is settled. The same algorithms that bought the hope headline now start selling the doubt. Oil bounces. Stocks give back ground. The relief rally turns into a question mark. Public narrative: ceasefire. Markets love peace. Market reality: we just removed the tail risk for a minute. Now we wait for the next headline. On the price of risk in the here and now. A narrow shipping lane halfway around the world can swing trillions in market value faster than any central bank speech. One fragile agreement flips the entire story, until the next tweet, the next strike, or the next denial changes it again. The wider danger is clear. The global economy is still wired to this single choke point. Even if the truce holds, oil prices stay elevated compared to pre-war levels. Inflation pressures don't vanish, and every future negotiation now carries the same hair-trigger effect on markets. One misstep, and we're right back to the February panic, only this time with even bigger bets already on the table. So here's the uncomfortable question that lingers. If a 2-week already wavering ceasefire can whip the entire market around like this, what happens when the real test comes? Because the strait never really forgets who controls it, and neither, it turns out, does the price of everything.